Hello everybody, my name is Lewis Gudgeon. Today I'm going to present a paper, DeFi Protocols for Loanable Funds. This is joint work alongside Sam Werner, Daniel Perez and Professor William Nottenbelt. We're all at Imperial College London. It's a real pleasure to be presenting at this venue, and I'm very grateful that despite the ongoing situation with the coronavirus, this event is still being conducted virtually. So here's an outline of what I'm going to cover today. So I'll start with a quick introduction before looking at the taxonomy that we develop in the paper for these protocols for loanable funds, or PLFs, and then move on to the three main pieces of analysis. So first is on market liquidity, so liquidity in these protocols. Secondly, going to look at market efficiency. And then finally, market dependence, so how the markets on these different PLFs relate to each other. So what is a protocol for loanable funds? Well, let's take as our starting assumption that we have a blockchain. Now, a protocol for loanable funds is just a set of smart contracts that is at some point deployed on that blockchain, and then from its deployment allows for funds between Alice and Bob to be intermediated. So in a nutshell, the protocol intermediates funds between users. What is important to note is that here, in this diagram, Alice is not directly lending to Bob, and Bob is not directly borrowing from Alice, but Alice is actually lending to the protocol itself, and Bob is borrowing from the protocol. So you can see how the PLF acts as an intermediary. And the way that it allows this to happen is by setting a pair of interest rates. So an interest rate that Alice receives for supplying and an interest rate that Bob receives for borrowing. It sets those interest rates and it sets them programmatically. So the way that the rates are set is just programmed into the protocol itself. So once the protocol is deployed, then in any subsequent transactions, so for example, if Alice supplies to the protocol or Bob borrows, then the blockchain is updated and kept synchronized with the state of the PLF. So one point that is important to make here is that PLFs do not replace banks. And the reason they do not replace banks is not actually entirely obvious. So you might think that traditional banks take funds from depositors and lend them out to borrowers. But actually, that's not how they work. So let's take a look at this quote from the Bank of England. The reality of how money is created today differs from the description found in some economics textbooks. Rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits. So when a traditional bank lends to a borrower, it is actually creating those funds. In contrast, a PLF lends out existing funds to a borrower. So one way to think about this is that a PLF is actually much closer to the idealized functionality of a bank that economics textbooks have used for many years. The building blocks of a PLF are as follows. So we have an interest rate model, which is some function that takes the liquidity in the protocol as an argument and returns an interest rate. Typically, you have an interest rate for savers and an interest rate for borrowers. We also have a reserve factor. So this is an amount that is deducted from a borrower's accrued interest, and it's set aside for periods of illiquidity. So a way to think about that is similar to some form of insurance fund in times of distress. We also have an interest rate disbursement mechanism. So this is some way where interest is typically accrued per second, and then it's paid out per block. Often an interest-bearing derivative token is used, and the main reason for that is to limit the number of on-chain transactions that actually have to take place and therefore reduce cost. Fourthly, we need some form of governance mechanism. Typically governance is decentralized or is eventually decentralized, and this decentralized governance is achieved through an ERC20 governance token where the votes that token holders have is just in proportion to their stake. So our focus in this paper is on three particularly prominent PLFs, Compound, DYDX, and Aave. We review the methodologies that were used to set the interest rates in these protocols. We then empirically study how the interest rate rules have behaved or been set since these protocols were set up. Then we investigate the market efficiency within a particular PLF, where we look at market efficiency by considering whether uncovered interest parity holds. More on that later. And then lastly, we also investigate how interest rate dependencies exist across protocols. So do some protocols lead the market, so set interest rates, and others follow? Okay, so I'm going to spend a few moments describing the taxonomy that we put together. So let's start with some main definitions. So at the heart of all of the interest rate models is some utilization ratio. So defining that as UM, so the utilization ratio for market M, that is the ratio of total loans L to gross deposits A. Then the interest rate itself is calculated as an index. So the interest rate index for this block is calculated by taking the previous block's interest rate, so that's IK minus 1 in market M, and multiplying that by 1 plus the per block interest rate R and the difference in block height T. Debt is calculated analogously, where this block's debt is an updated index of the previous block's debt, and the reserve factor pi m is calculated by taking the previous block's reserve and adding to that some portion of the previous block's debt that has been retained, and the portion that is retained is defined through lambda. The first application of these interest rates is in the form of linear rates. So with linear interest rates, the borrowing interest rate is calculated as some constant alpha plus beta times the utilization ratio. So beta essentially captures the responsiveness of the borrowing interest rate to the utilization ratio, where saving interest rates are calculated similarly except further scaled by the utilization ratio. This creates a wedge between the borrowing rate and the saving rate. So another variant of these interest rate models is in the form of nonlinear rates. So with nonlinear rates, the idea is that you may want the interest rate that is set in your protocol to somehow respond differently to high levels of utilization. So for example, you may want it to be the case that for very high levels of utilization, your interest rate increases more sharply. So it responds in a nonlinear way to the utilization ratio. The reason you might want to do that is because you might be concerned that at very high utilization ratios, your protocol is less useful for users because depositors are not able to withdraw funds, and potentially also less economically secure. So in this example, the interest rate IBM is calculated as alpha times the utilization ratio in market M plus beta times that same utilization ratio but to the power of 32, and plus gamma times that same ratio to the power of 64. So the last interest rate model that I'm going to look at are those for kinked interest rates. So the main idea here is that you define some optimal utilization ratio U star, and you say if my utilization ratio is below this, then we will set interest rates in one way. So this is alpha plus beta U in the linear model form. If, in contrast, the utilization ratio is above U star, then we have this additional jump multiplier, gamma, which increases the interest rate more aggressively. So this allows protocols to more sharply disincentivize borrowing as the utilization ratio increases above some threshold. So we can see how these kinked interest rates have evolved for compound by looking at a number of regime changes. So here I plot between 21st of February and the 13th of March a wireframe which shows the theoretical interest rate model, and these black crosses which show the actual interest rates that materialized. So we have the interest rate on the z-axis, and then on x and y we have borrows and supply. If we have a look at this through time, we can see that the interest rate fluctuated above the optimal utilization ratio, and then hovered around the kink itself. So around the 8th of March, the interest rates are very much on the kink. And then oscillate around this. Focusing just on dye markets for compound RV and dydx, on the left we plot the total amount borrowed and supplied, and what you can see is that there are periods where the utilization ratio is between 80 and 90%, so those are shown with this salmon pink color, and then where the utilization ratio goes above 90%, that is shown by the red shading. And what's notable is that there are quite a few occasions where the utilization ratio is high or very high, so above 90%. So for dydx, this is much of January through to mid-March. And then for RV and compound, there are also periods where the utilization ratio is that high, particularly around the 12th of March, which was, of course, Black Thursday, where the supply very quickly contracted and the borrow amount didn't, and you can see that this resulted in very high utilization. On the right hand side, we can see these utilization ratios and the borrowing rate explicitly plotted, and let's just focus on the bottom panel for compound. Here we can see that there are some points where the utilization ratio becomes very high, corresponding to Black Thursday around the 12th of March. Something else that we look at in the paper is the distribution of dye funds across accounts for compound. So taking a snapshot on the 6th of April, we plot here the cumulative percentage of locked funds by number of accounts. And what's quite notable is that this snapshot, at least 50.3% of all of the locked dye was controlled only by 3 accounts. We're going to change gear now and look at market efficiency. So to look at market efficiency, we're going to look at uncovered interest parity. Now, the main idea behind uncovered interest parity is typically considered in terms of a foreign currency and a domestic currency. The idea is that if you have a return on your foreign currency and your domestic currency, those returns, once you account for the impact of the exchange rate, should be roughly equivalent. To test whether this uncovered interest parity holds, we test the following empirical specification. So we take the difference in the exchange rates and we regress this on some constant alpha plus beta times by the difference between the interest rates. So we focus specifically on compound and construct 20 market pairs between the tokens available. Looking first at daily data, we find that for both borrowing and saving rates, in all cases, uncovered interest parity does not hold either in a weak form or a strong form. So the strong form requires both the alpha and the beta coefficients to have values of 0 and 1 respectively. Looking at weekly data, we find for borrowing, there is actually some evidence that suggests uncovered interest parity does hold in its strict form. That's for 8 out of 20 pairs. And for the weak form, we find that for borrowing 11 of 20 pairs, there's some evidence that it may hold. And for 9 out of 20 pairs, we find that for saving, there's some evidence that uncovered interest parity may hold. It should be noted, though, that the standard errors, which are reported in the paper in the appendix, they're so large that it's really quite difficult to reject any hypothesis. So really, we're not overly confident that uncovered interest parity is holding in these markets. So turning to the last piece of analysis that we provide in the paper, we look at market dependence. So the idea here is to ask the question, can we spot some relationship between the time series of different interest rates in different protocols? So this is the definition of a vector error correction model. I leave that there for reference. And what we plot here is the borrowing rates across protocols for dye. We have compound as the solid line, the larger dashed line is for dydx, and RV are the smaller dashes. We can see on the face of it, it seems like there's some similarity there between the borrowing rates. So let's start with the VECM regression results for dye. So what we find there is that there's evidence that when the borrowing rate on compound is high, Aave's borrowing rate quickly adjusts to match it. We have a coefficient of 0.38. Similarly, dydx behaves in the same way. So when the borrowing rate on compound is high, the dydx borrow rate also quickly increases to match it. However, there is not evidence that the compound die rate adjusts to changes in Aave or dydx. So what this suggests is that compound seems to be setting the prevailing market rate for borrowing in all markets for the sample period, at least. Here we have the impulse response functions, which show how for a shock to the compound interest rate, how this impacts the interest rates for Aave and for dydx. In summary then, so we have shown that PLFs often operate with high utilization, and these moments of high utilization are often shared across protocols. We've also found that token holdings can be concentrated to a very small set of accounts. So remember that in compound we found that 3 accounts controlled 50.3% of the funds for DAI. We also find that uncovered interest parity, broadly speaking, does not hold, particularly with daily data, where we find no evidence of that, which suggests that markets are at present relatively inefficient. What we also find is that the borrowing rates on these protocols seem to influence each other. So for the sample period, we found that compounds seem to have some market power to set the prevailing borrowing rate for Aave and dydx. That is all I wanted to say. So thank you very much for listening, and I'm very happy to take any questions. Thank you.